Welcome to Cross Search. I'm Jody Papike. Today I wanted to chat about the environment that we find ourselves in the financial services industry as it relates to consolidation. And consolidation within the marketplace has really been affecting advisors dramatically, especially over the last 5 years or so. And to illustrate this, I think it's interesting to note that I'm working with several advisors currently that have been so impacted by consolidation. One in particular, she went to a firm that was acquired. She left that firm because she didn't want to go to the acquiring firm, went to a new firm that she really, really liked, and is now back in that same situation because the new firm that she chose has been acquired again. And this has created an environment where advisors are just very, very skeptical of the firm that they're with. And they're very skeptical that any firm they choose to go to is going to keep the same ownership structure. Just really created a lot of instability in the marketplace. So I wanted to expand on it today and just talk in general sense. In why this is happening is because so many private equity firms have come into the financial services industry. And really the objective that they have is to create a platform that becomes very profitable. And historically, those firms will keep the firms for anywhere from 3 to 7 years with the intention to sell it again. This has created a lot of the consolidation that we've seen. And then also the move to advisory business, because that revenue for either an RIA or a broker-dealer has increased so much, that revenue is recurring and predictable, a predictable revenue stream for those firms, and therefore more attractive to buyers. So the question for today is really what an advisor should do if they find themselves in a situation where the firm that they're with is acquired. And I think the most important question to ask before you do anything is how that new purchase is going to affect you. Either A, is it a buy and hold type acquisition where the firm is coming in, buying your current broker-dealer or RIA, and keeping everything the same. They're keeping the employees in the back office. You will literally remain with the same firm. In that case, you're actually in a best case scenario situation. Because if any change is to come, it will probably be somewhere down the line, somewhere in the future. But even if it is a buy and hold purchase, it's important to look at who the new buyer is. What are their long-term intentions? Do they own any other firms that eventually you could be rolled into? And kind of have a plan if that should take place in the future. If you find yourself in a situation where it's not a buy and hold, but it's actually a roll-up type scenario, unfortunately, that's worst case scenario for an advisor because they literally need to start the due diligence process just like they would be looking for a new firm and look at the entire structure. That can mean everything from, will your clearing firm change? And if that's the case, all of your accounts will get new account numbers. And going along with that, asking very detailed questions about the paperwork involved. A lot of times I find when there's a purchase of a firm, this topic will be covered in a very vague manner. And you'll hear the words that, it will be a paperless process very frequently. But unfortunately, that's not always the case. And a lot of times advisors stick around thinking that there won't be much paperwork in the process, later to find out a lot of times when it's too late that there actually is paperwork involved and a lot of change involved. For example, if you're going to a firm with a new clearing firm, let's say, you were NFS clearing and you're going to be consolidated into a firm that's now Pershing clearing, all new account numbers, all new technology, all new systems for your clients to access their accounts. So that really can mean a lot of change for you, your back office, and ultimately your clients. Also, for advisors, they need to really dive deep into compensation. Will they remain on their same payout grid, or will there be change coming with that? Will they be going on to a new admin fee schedule for advisory business? And what will be changing for your ongoing economics, things like E&O, insurance, and technology costs. Just really doing a deep dive into how will your net income change with this new firm. Also looking at the service structure. If you are being rolled into a firm and you're used to really good service, really talking to advisors that are at that new firm and understanding what does their back office look like? Is there enough staff to service the advisors that are there? Because if you think about it, that new firm that you'll be going to is used to serving however many advisors they currently have on their platform. But once you roll up into them, however many advisors are rolling into them will now have to be serviced as well. And that can impact the way that you're serviced and supported. And then also product availability. You can't just assume that everything you're doing at your current firm is going to be approved and allowed at your new firm. So literally starting over and making sure that everything you're using, all the products are approved, or if they're not approved, going through the process of making sure they are approved on a go forward. So as you can see, there's so much to cover on this topic. Unfortunately, it's something that comes up in almost every conversation that I have with advisors in the environment that we're in. And that's because there is so much consolidation happening. There's so much fear in the marketplace about making the wrong decision or going to a firm and having to deal with a buyout. So it's something we help advisors with every single day. If you have any questions on this topic or you want to explore your opportunities, we would love to talk to you. Give us a confidential call.